I studied what the wealthy did. I want to do what wealthy people do.
Yeah.
What do they do and how do they invest? What if I could get on that compound interest curve and stay on it literally till the day I die? I'm going to have a tax-free retirement in the future, because in retirement, I'm going to take and just spend them personally. I put the in the first limited partner I did. So I was able to get my dollars back, and now I have about a 3% cash flow, about $10,000 a year. I still have the plus in equity. Can be used for an infinite amount of things. I like to call it a sexy opportunity / emergency fund, because when you're ready for that opportunity, that's going to be game changing. The number one greatest investment you could possibly make in your life is
Welcome to the Wealth Through Real Estate Show. Today we're joined by Darren Mitchell, an entrepreneur, an author, real estate investor, and financial advisor. From pre-construction to private lending, Darren's built a diverse real estate portfolio while educating investors about the concept of infinite banking. Get ready to learn how to take control of your money, scale your portfolio, and make smarter, more strategic investment decisions. Darren, welcome to the show.
Thanks for having me. Excited to be here.
Now, Darren, can you tell us a little bit about how you got started in real estate and what your journey's been like to this point?
Sure. So probably going back 8 or 9 years now, I went to one of those couple hours where a guy comes in and gives a little talk and then sends you to a boot camp. And then the next thing I know, I was part of a real estate group. And looking back, that was probably one of the smartest things I did. I find both in my main business, which is the control and compound, as well as my real estate world, you can talk to your friends and neighbors and they think you're crazy what you're doing. It's so nice to be in a part of a community where it's like, oh, loaning money out at 15% is normal, or, leveraging all kinds of stuff to buy more properties, that's normal. So it was a huge win for me to be part of a real estate group. And that really started my real estate journey. And now we help real estate investors across Canada with infinite banking. And we probably have 85% of our clients across Canada are real estate investors. So we're immersed in it. We're at all the conferences. We're learning this stuff every day along with our clients, and just a fun industry.
I love that. And you know what I particularly liked is the fact that you highlighted the benefit of the community, because your environment is everything. So just putting yourself into that environment allows you to grow in that right direction. So okay, so on the personal level, you got into this environment, you decided, hey, I want to get into real estate investing. What were those first initial steps? How did you get your feet wet?
Yeah, so the first thing I did was a private lend, and that was great. And I've done several private lendings that worked well. I haven't done one for a while. I love the private lending, but I didn't love the tax you pay on the private lending, because it's depending upon your income, that in my province, we have a top tax bracket of 54%. So we're fortunate enough to be number one in the country in something. So, but private lending, it's been great for me. When you're using, non-registered money, it gets a little more difficult. And then I kind of went on from there with a fourplex and a couple of condos, and I learned fairly, my learning journey was, don't love being a landlord when I have a full-time plus business to run. And now I've got a little more into passive investments with GPLPs, land development, stuff along those lines.
Okay, so for maybe those newer investors who are like, okay, I get the condo fourplex, I understand what that means. What about land development, GPLPs? Would you mind sort of breaking down what that looks like? Like most new investors, they understand, okay, investing in a buy and hold condo or fourplex, but they're like, you know what? I get that, Darren. I want to be a little bit more passive. I want to be a little less of a landlord potentially. And maybe I want to follow the path you followed. What did that switch look like? What does that entail?
Yeah. So for me, I started. First, the sort of step was trying it on my own. Then it was joint partner. where I was like, okay, I wanna have all the upside of real estate, but I don't want to manage tenants, termites, and toilets. Um, and then now I'm more of a passive investor. So I'll give you an example of a couple deals I did in the last few years. Um, Now, again, I incorporated my main business, what cash value life insurance. So I had an opportunity to put $200,000 into a limited partnership. So an LPGP. So there's a general partner that manages day to day, does all that stuff. And then the investors come in and they invest money. And it was a 39 unit building. And the idea was you put whatever money in, and they were going to do renovations, fix it up, increase the rents, go back, refinance it after 2 years, and give you all your money back was the plan, and then start paying a cash flow of roughly 5%, but you get all your money back in 2 years. So that really appealed to me. I was like, oh, great, I get all the upside of real estate. I get tax efficient real estate coming back as return of capital. So I paid no tax on that. So to fund that, I went to one of my insurance policies and I said, why don't I leave that money inside the insurance company, let it grow tax free for the rest of my life, provide a tax free retirement and a death benefit for my family. But I used the insurance company's 200,000. So they said, I called them up and I said, hey, can I have 200,000? And they said, sure. They didn't ask me what I was using it for, what my financials were. They just said yes. So I took that 200,000. I paid 6.5% interest on that loan. I put the 200,000 in the first limited partner I did. And you know how these deals don't always work out as you plan? Well, this
Yeah.
one didn't, but it was on the other side. They actually called at 18 months and said, listen, we're ahead of schedule. We're going to do the refinancing now. So I was able to get my $200,000 back. And now I have about a 5% cash flow, about $10,000 a year. I still have the 200,000 plus in equity because when they gave me my money back, it was just a refinance. I wasn't cashing out of the deal. And then I took that 200,000 and I repaid my policy loan on my insurance contract. So that deal, 6.5% for 18 months, that cost me about what, $10,000 in interest. No, sorry, it cost me 20,000 at 200,000. So it cost me
Yep.
$20,000 of interest. So it was 13,000 the first year and about 6,500 the next 6 months. And because I borrowed to invest, that was a tax deductible expense. So it really cost me about 10 grand after tax. So for 10 grand after tax, I still have my money in the policy growing tax free for a tax free retirement, a tax free death benefit. I have this $200,000 plus in equity. I have $10,000 of cash flow coming in a year, and it really only cost me 10 grand. So I got pretty excited when that happened, and then I just hit the rinse and repeat button, and then I literally did the same thing all over again. The next one was a student rental, and I
Okay.
don't know if you've ever had a student in university, but I've had a couple, and that's not a field that I'd be excited about managing, but it's a real profitable industry for those that are experts at it, know how to run it, manage it. So it was the same idea. I put in the same amount of money. That cash flowed initially at 3.5%. And that 3.5% was enough to cover my 6.5% policy loan because the policy loan was tax deductible. So it cost me about 3.25 on the 200,000 net. Cash flows paying for that. And they sure enough, they're increasing the rents because those student rentals come due every 12 or 24 months. The students move out. So they were able to
Yeah.
increase the rents to market rate, and they're hoping another 18 months before that one's going to refinance. Same idea, get that money, come back to me, put it back in the policy, and look for the next and opportunity. So my money's in the policy, and it's providing a death benefit, and I have this real estate. So I've incorporated these two age-old strategies of cash value life insurance and real estate, slapped them together, and that's what we help our clients with.
I love that. Now, I'm sure people have probably seen potentially like TikTok videos, short videos of people explaining how this works. But do you mind giving people just a little overview on how you got to that point where you were able to say, "Hey, I want to take I want to lend 200,000, kind of no questions asked, and invest this into some real estate venture. How do you work your way to that point?
Yeah, great question. So, it's I always say cash value life insurance because the way it's structured, it works so much. It's so very similar to real estate investors. That's why it's a perfect fit. So at the end of the day, there's two pieces to an insurance contract. There's a death benefit and cash value. Most insurance contracts have no cash value. That's your term insurance. You buy a 500,000 or $1 million term. The specially designed product we use is we're not really focused on that death benefit. We're trying to drive it down as small as possible. But what I learned when I studied the wealthy is don't give up control of your money. So where are you going to save or store your money? What are your options? I can put it in the stock market. Okay. If the stock market drops 40%, are you really going to cash out to take advantage of an opportunity? Probably not. I could put it in an RSP, same idea, stock market in tax. I could put it in cash and lose probably 6 or 7% a year with devaluation of the dollar. Or I can put it in this cash value. In long term, your cash value is going to grow roughly 5 to 6% tax free. The beauty of that is it's going to grow tax free. So that's like a 10, 11, 12% return, depending upon your return. But I caution you, it starts like a renovation. And what I mean by that is, if you put $25,000 a year into an insurance policy, it's not an expense. It's an asset, right? It's just on your balance sheet. And you could cash that out and take the cash at any point. But year one, it starts slow. So what I mean, you're underwater. It's like you did a reno. So if you put 25,000 in a contract year one, you have less than 25,000. You might have 17, 16, 18,000. By year two, you're putting in 25, you're growing by 23, 24. Usually by year three, now you're growing by what you put in, and now you're going to stay on that exponential growth curve. So to get $200,000 in, depending upon how much you start, if you started at 100 grand a year, you could probably have that in two and a half years. If you started at 10 or 20 grand a year. So the concept doesn't work well for someone looking to save $500 a month because the time it would take to set that up. But basically, you deposit a period of money in the contract for a period of time. You start underwater, long term, you grow. But the really cool part for real estate investors is that loan part we referenced earlier. Because when I go to take a loan, there's three really unique things about this loan. So if I have, just say I have 100,000 in there, it's contractual that they have to loan me 90% of that, no questions asked. They don't ask for anything other than they ask me two questions. Do you want a check or do you want a deposit in your bank account? Those are the only two questions they ask. The next thing about the loan, it's tax deductible because I'm using it for an investment. It's uncallable. And I can't tell you in the last 8 years how many real estate investors I deal with that have lines of credit that they think are awesome until they're not. And until they get that call from the bank saying, listen, tenants aren't paying, you lost your jobs, value of your properties went down, we gotta call this loan. So the uncallable part is huge for real estate investors. And then the last part that gets real estate investors really excited, the loan is unstructured. And an unstructured loan means, in that example, if I borrowed 90,000 on my 100,000, I can pay that loan back when I want, how I want, if I want. So the cool part is, great, I plan to pay those loans back over a period of time. But if something went sideways on a project, well, great, I'll just not repay the loan for a while. Or the cool part is if I have 100,000 in there and I borrow 90, I still have 100 grand in my policy growing at 5 or 6%. So fast forward 3 or 4 years, maybe now the deal goes south. I stop making repayments. I reborrow what I paid back over the last couple of years, and then I borrow some of the growth I've had since my 100 is now 110 or 120. So it really, to me, the number one thing when I studied the wealthy is they want to be in control of their money. And then we can get into the three places that wealthy people invest. And, I'm not trying to reinvent the wheel. I studied what the wealthy did. I spent 2 years and multiple six figures traveling around North America after the crash of '08. And I said, I want to do what wealthy people do. What do they do and how do they invest?
I love that. That you actually broke it down really simple. It made it really easy to grasp and understand the concept of it all. So, for everyone listening out there, there's a slower start, and like everything, you start getting that exponential growth. Now, you said something that really intrigued me is you could take money out, and then you don't even have to pay that money back, but you could leverage some more of your growth down the line. Is that correct?
Yeah, absolutely. Now, again, in the early years, we like if you're in your 30s or 40s or early 50s, we say you should make a plan to pay it back, because if you
Yes.
don't pay it back, then you're not going to have as much money to access for the next deal, right? So
Yes.
I'll typically look at it if I'm doing a private lend for a year, I won't make any payments on that. I'll just say, great, I'll let the interest accumulate. So the private lend, borrow 100 grand, loan it out at 15, get a check for 115 in 12 months, take 106.5 of that, pay off the $100,000 loan plus the interest, pocket the difference. That's an and asset in our books, because my money was in two places at the same time. I literally multiplied money. But if I'm doing a longer term loan where, I'm not, maybe I bought a fourplex and it's cash flowing every month and I'm paying down the loan, I'll repay it when I refinance it, maybe at year 5 when the mortgage comes due. But on that one, I'll make some payments on that as we go along, because again, your money needs to reside somewhere. I'd rather it reside in my own banking system than in the bank sitting there in cash.
Yeah.
And the cool part is there's no fear of putting that money in year 2 or 3, because if I change my mind the next day, I can leverage 90% of that. They'll fire it right back in my bank account. So that's pretty exciting, both personally, and then we can talk later about corporately as well, which is even sexier.
So, question for you is, when you're lending the money, you're not lending it from your own private reserve. You lending it from the insurance company essentially, right? So let's say you lend. You said you could lend up to like 90%, and situation changes and you're not paying that back. Is there ever a point that you can get where the interest that you're being charged on that is potentially higher than the growth that you have, and it can sort of start working sort of in a moving negatively? Does that make sense?
Yeah, yeah, 100%. So these products have been around since 1846, or older than Canada. Both the four companies we use, the newest one is 100-year. So historically, the dividend rate, what they pay each year, is pretty close to the interest rate. Okay, so if we did an example of, you have 100,000 in there growing at 6%, and you borrow 90,000 and that grows at 6%, well, those should never catch each other. Now,
Yeah.
with the increase in interest rates in the last couple of years, we had a bit of a blip. So you could be in a situation where now in year 3, if you didn't pay back a loan, you could be at 91%, and you might have to pay a couple $100 of interest just to keep it at that 90. But if you think of it from the insurance company standpoint, why are they loaning you 90%? Like 90% is a big percentage. Why do
Yeah.
they, loan 70 or 80 on real estate and 90% at this? Well, that 100,000 in my example, the insurance company guarantees it never goes down, guarantees it goes up, and they've paid a dividend every year for 100 years plus. Worst case scenario, you die. Well, we didn't even talk about the death benefit yet. If I have $100,000 cash value, my death benefit's probably 500,000. The insurance company knows with certainty you're going to die. So they go, we know we're going to get this money. So now my $90,000 loan grew to 110. My death benefit grew to 510, and I die, and they say to my wife, hey, Darren had 510,000 of insurance. We're going to subtract the 110 he borrowed, or borrowed 100 plus interest. Here's a check for 400,000. So they know they're going to get their money back. That's why there's no structured repayment, because worst
Yeah.
case scenario, they'll wait you out because you're going to die.
Now, one thing I'm curious about is, money standing still is never a good thing. We know how the banks make their money. Well, most people, at least most people that are somewhat educated in that. Curious as to how the insurance companies make their money, because ultimately, at the end of the day, they need to keep afloat so that they can pay you out, right? What do they do with the money that you park in on their end? How do they multiply that so that they can stay profitable and keep things going?
Sure. So for the products we use, participating whole life, you don't get to choose the investment. There's one investment called participating whole life fund. And that fund is invested a lot like real estate investors. They've got a good percentage in real estate, They do private lending. Now, when they do private lending, it's a little more than $100,000 for the local developer. They would loan money on like the 407 toll highway in Toronto or the bridge from New Brunswick to PEI, major infrastructure projects. They're going to have government bonds. They're going to have a little bit in the stock market. But the key is they're going to invest that money. Two big things. They say a young guy like you, and they say, oh, you buy a life insurance contract. They're like, all right, we've got to set up a reserve to pay that future death benefit, but you're not going to die for another 50 years. So they're going to put money aside so they can pay that. That's kind of why we're underwater year one. They need to pay an advisor and they need to put up this reserve. But they can invest that money tax-free because of the tax laws in Canada say growth inside an insurance contract's tax-free. And they can do those long-term projects because they're not worried about making next quarter's numbers to make their shareholders happy. They're worried about having enough money to pay a death claim in 50 years. So if you think of it, because like the lender is the insurance company and the guarantor of the fund not going down is the insurance company. So that's why they're going up to 90% because it actually is a much less risky loan than a real estate loan at 80% is, because real estate can burn, it can stop paying tenants, it can be, all kinds of bad things can happen to real estate, go down in value. Nothing can blow this up. So it's a peaceful way to live, because I say to real estate investors and business owners all the time, listen, you take enough risk. You've got real estate properties, you might have a business. For your savings, let's put it in something rock solid, bulletproof that can't blow up. And then if, to your point, money stagnant does nothing, well, what if we can put the money in there and then literally multiply it? It's in your policy and it's providing a death benefit and you're using it for real estate business opportunities, Bitcoin, I don't care what you use it for. We call it infinite banking for a reason. The policy can be used for an infinite amount of things. I like to call it a sexy opportunity/emergency fund. Because when you're ready for that opportunity, that's going to be game changing. The deal of a lifetime always happens for one reason. One guy has money, one guy has money or access to money, one guy needs money. So I want to be ready for those opportunities where people say, well, how much do I have to put in? I go, you don't have to put in anything. If you want to continue to devalue your money, not be able to grow it tax-free, not have a tax-free retirement, you don't have to put any in. It's how much do you want to put in? So, for me, I stopped RSPs years ago because I realized that money was in prison for me. And as a business owner and as a real estate investor, I want control of my money, but I want it in a nice, safe spot. This is the safest spot with growth that I could find. It's either this or cash, and this blows away cash.
I love that. So for investors that are listening and they're like, you know what? I potentially want to start making that break from the traditional funding sources. How do I go about doing that? Is it something as simple as redirecting the flow of the money into the policy and then taking it out from there to invest and sort of treating that like their quote unquote savings account where they putting the money in to take out later and jump into opportunities? Is it as simple as that?
Yeah. So like I believe you should put your money in the insurance policy first and then take advantage of the opportunity. So like that private lend I talked about, I could have taken 100,000 of personal money, put it in the private lend and had one rate of return. Yeah. But instead I put it in the policy first, then I did the private lend. So my policy, the 150,000 was growing tax-free, and I had the 15% minus the interest rate tax deductible that I paid on the loan, and I had a death benefit. And, we always tell people what I learned when I studied the wealthy, another thing is there's 4 wealth destroyers that are going to kill you. And if you don't get a handle on the 4 wealth destroyers, it's really hard to be wealthy. So think of high school math, your exponential growth curve. Well, that's what we want to. We want to get on the exponential growth curve and we want to stay on it for life. And the 4 things that knock you off that curve, number 1 in Canada is tax. Well, we eliminate the tax because it grows tax-free, the loans are tax-free, and the death benefit is tax-free. The second one is volatility, right? Volatility kills you whenever when does the opportunity happen? When things aren't going well. Real estate's down, stock market's down, great opportunity, things are on sale, but nobody has access to money. So we eliminate the volatility. Fees, the average mutual fund in Canada is still charging a 2% fee. The fee on this is 0.13%. So an incredibly low fee. And then the fourth one, the biggest one, on top of taxes would be spending, right? People start saving money, saving money, saving money. They're just starting to compound it. And then they go pay cash for something and go right back to zero and restart the compounding. So what I learned from the wealthy is, what if I could get on that compound interest curve and stay on it literally till the day I die? Well, now I'm going to have all kinds of cash value. I'm going to have an opportunity fund that I can multiply my money to take advantage of opportunities. I'm going to have a tax-free retirement in the future, because in retirement, I'm going to take those loans and just spend them personally. Let's say you're 60 or 70. Now I take 100 grand out a year tax-free. I die owing $1.5 million. Who cares? My death benefit's $3 million. So again, the insurance company takes that off. The death benefit still provides my family a bunch of money that they can keep the properties, keep the business, pay the tax, and live. So it's really, I think, the base of a financial plan. It's what I learned what the wealthy are doing. Like over $1.1 billion last year went into this in Canada. Like, people don't talk about it because the banks can't sell it, and it's not going to get you, you're not going to be cool at a cocktail party in the neighborhood. You're just going to be wealthier.
Now, question for you is, for an investor sitting and listening, they're like, okay, everything sounds great so far. I'm just trying to wrap my head around how it competes with traditional financing options in terms of speed and cost. Now, you've highlighted some of this, but in terms of, let's say, speed, what does that look like? I want to get access to my money. How fast can I get access?
Yeah, they process it usually in 48 hours, and then we tack on 3 or 4 days for it to actually show up in your bank account because of our archaic bank system, where it still takes a while to make it to your branch. So we tell people 2 weeks to be safe.
Yes.
So 2 weeks before you need the money, let us know, and it's literally a click of a button on a form or a call. And great, I'd like X amount of money. That's the simple version. There's higher end stuff where we can actually get loans from third party institutions. That's a little more paperwork to do, but like banks will loan on this. There's specialty banks that were built just to loan on this cash value. Because again, from a lender's perspective, it's the ultimate asset to loan money on, because it's guaranteed to go up, can't go down, and there's a death benefit if the guy dies. So there's other lending institutions, but for most people, that policy loan is the simplest. You literally call up the insurance company or call our office if you're dealing with us, and we handle everything. We track the loans. We do all that. So it's a perfect finance vehicle because there's no qualification, there's no questions asked, there's no ands, ifs, or buts. It's just automatically given to you. I've been in the business my whole career, and never once has a insurance company ever called a loan, because they can't. It's contractual.
Question for you is, because you've not only implemented this yourself, but you've helped countless other people as well. What's some of the common initial steps that you take when, let's say, you have a consultation with someone and they're like, I've got a couple of properties here and there. I want to implement this so that we can get things going. What are some moves that you may advise them to make?
Yeah. Well, I'll start with this. So when I studied the wealthy, I learned the wealthy do 3 things. So if you want to invest like the wealthy, you got to do these 3 things. The number one greatest investment you could possibly make in your life is an investment in yourself. Okay.
100%.
You are the greatest asset. You're the golden goose. So if that's join a real estate group, get a real estate coach, get a business coach, go to a Tony Robbins event, take some education course that's going to level you up. Remember we had a 24-year-old client a few years ago who joined a real estate group and got a coach, and he bought a 14-unit apartment building with none of his own money. Now, that guy's going to make millions of dollars, and most people his age are really worried about, that $5,000 RSP contribution, did it go up 6 or 8%? Like, who cares? So invest in yourself. Second way you make money is you invest in business. And the third way is you invest in real estate or some other hard asset. So going back to step 1, investing in yourself, this isn't a concept that you can hear me on this call today and say, great, I'm in, sign me up. Because you do have to do the investment in yourself to learn this concept. Okay. So we've got all kinds of resources at controlandcompound.com. I think we've got a link here for your listeners for a special VIP treatment. But I wrote a book called Be the Bank, where I talk about this. It's available on Amazon. I have one Infinite Banking for Real Estate Investors, available on Amazon. We have a free webinar that people can go to the website and watch the webinar. So we have a podcast, Control and Compound, with 160 episodes. So we encourage people, learn about this, listen to the podcast, read a book, do something. And then when you're ready, then our process is we have education sessions. We're not going to hard sell you. An education session, meet with one of our coaches in any province in Canada outside of Quebec, and they'd spend an hour and a half educating you on the concept. And at the end of that call, if you said, you know what, thanks, not for me, that's great. If you said, okay, I'd like to learn more on how I implement it, we can set up subsequent calls and educate you and build a program specifically designed for you. Because there's all kinds of people now that, I've been online for a while, and a few others that, oh, I can do that too. Well, this is all we do. We do cash value life insurance for real estate investors and business owners. This is our specialty, and there's a lot more to it than people think. And it's great. Maybe set it up, but is it set up properly? And how do you use it properly? And because we meet people all the time that they have a contract they bought 10 years ago, and they have no idea what it is, how it's working. They haven't used it. They haven't multiplied their money. So we're big on education. So we start with learn a little, then come see us. We'll teach you. And it's literally at the end of that education, you decide what path you want to take. But the number one step is invest in yourself and learn this concept, learn other concepts, learn more about what you want to do. But to me, there's no better thing for a real estate investor or a business owner, because those people need access and control of their money, because they realize they're going to make the money investing in themselves, business and real estate. So that's why I like real estate investors, because they're already not following traditional finance, right? Traditional financial planning. I always joke, I go, we don't have a lot of government employees as clients. We have some. We don't have a lot of teachers. I have one teacher client, and I had to marry her. So outside of my wife, we don't have a lot of teachers coming to us. Because great, they have pensions, they have put a little money in RSPs, that's great. But if you're an entrepreneur or you're a real estate investor, for you to give up control of your money, to lock it away in a government plan where you're going to pay taxes, again, I call it maximum security prison. It's there until you're 65 or 70. Like, think of saying to a young guy like you, hey, what I think you should do is your best course of action is, why don't you give up control of your money, wait 40 years, when you turn 70, we'll turn it into a RIF, and cross your fingers, there'll be enough to get by every month. Or even better, and then again, full disclosure, I used to be a traditional financial planner back in the day. And I look back and I just shake my head. It was like the pitch was, hey, if you invest with me for 30 years, tell you what I'm going to do for you. I am going to make you poorer in retirement than you are today. So you'll be in a lower tax bracket when you take those RSPs out. Who wants to be poorer in retirement? The client's idea would want to be wealthier. So the idea of being in a lower tax bracket to take your RSP out is just, I think, crazy for a lot of people, because if you're successful at real estate and business, you're probably not going to be in a lower tax bracket.
And that's the thing. Most people aren't living comfortably in their retirement. So you can't do what most people are doing, right? You need to be doing what the wealthy are doing. Now, one thing that I want to question is, you said the first, I think, did you say it was like 4 steps? The first one is educate yourself.
Educate yourself. And then right on our site, or that link, the link in the show notes, there's a link that you can book an appointment with one of our wealth coaches just for a free education session.
Perfect.
Now, again, like, I'm upfront, like, we're not for everybody.
Yeah.
Like, if you're looking to put in $300 a month and, you got a part-time job and you don't know where your future is going, you're not ready. I'm not saying you're not a great person. What I'm saying is you shouldn't be doing this concept at this point. If you can save, $10,000 a year or more, great. We can show you why it would make sense to redirect that savings here. Maybe you stop your RSP or TFSA and say, save here. Or if I'm sitting on a lump sum and you want to put it in, we got phenomenal strategies for you. But we tell people no all the time, and we're not telling them because we don't like them. We're telling them because it's not best for them. And, we plan on being in business for another 50 years. So we're only going to deal with people that should be using this concept, and it's not for everyone.
100%. I love that you highlighted that, because yes, there's that's something that I was going to ask is like, who's this a good fit for? And then who isn't it a good fit for? And I guess the step one, educating yourself, ties that in. Once you educate yourself, you could potentially increase your income, get a better handle over your finances, and then start taking control of it all and then get things set up, right?
Yeah, absolutely.
So question for you, for investors out there listening. Well, maybe this works for like trying to see how they can tie this out with real estate. Maybe this works for short-term investment strategies or long-term investment strategies or loaning it out. Do you find that it works best for specific strategies and maybe a little less ideal for other strategies? Or could it work across the board from like flipping to wholesaling to short-term rentals? Like, does that even matter?
Yeah, I can't think of one of those things that you just said that we wouldn't have multiple clients doing. The only thing I would caution people on is in year one, you're going to have less money than if you didn't do it. So I tell people all the
Yeah.
time, listen, if you're sitting on 100 grand and you know with certainty you're going to put that 100 grand into a real estate deal in the next 6-12 months, then you shouldn't put it in the policy first, because we're not going to be able to give you a loan of $100,000. So if you're, willing to either have access to a little less money in the first couple of years, or you're willing not to take a loan for 3-4 years. Now you can get a loan in the first year, but again, your loan would be, a fraction of what you deposited in year one, because you are on that, underwater year one. But I love it because I use it as short term. I used to save money this way. I'd put money short term in a bank account because I'm going to need that. And then my long term money I'd put in prison, RSPs. And I'd put the money in RSPs and say, that's my long term money, that's my short term money. Well, now I put it in my policy, cash value life insurance policy. I can use it in the short term. If I need to make payroll next quarter, I can borrow that money to make payroll. I can do a real estate deal in 9 months, but I'm also using it for deals in 5 and 10 years as my cash value grows. And I'm using it in the long term for a tax-free retirement, because that's my goal, or a goal for a lot of clients is, how do I get in a tax-free retirement? How do I get efficient real estate where I'm refinancing, taking that tax-free money back? I'm taking loans for my cash value life insurance that I'm not paying back. There's all kinds of other things. Like, if you have this death benefit that people don't get excited about early on, a lot of people, well, if that death benefit, picture you when you're 70 years old and you have a house for 3 million, 4 million bucks, whatever the inflation is going to be by the time you get there. And you go, well, who would want to have a mortgage on their house at age 70? Okay. But if you had a $5 million death benefit, all of a sudden that frees up a couple of things to say, oh, well, maybe I will take 100 grand a year line of credit against my house, die owing $1 million. Who cares if there's a 5 or now maybe $6 million death benefit by the time you die? So there's all kinds of options in retirement. So I talk about that in my book, Be the Bank. Like, I just give 5 examples of retirement options, because when I study the wealthy, they want multiple streams of income and multiple retirement options. Traditional financial planning says roll the dice, put it in an RSP in the stock market, and as long as that works out, you might be okay. What are you going to do when you're 70 years old and you have $1 million in RSPs and the stock market's down 40%? You're probably still going to want to sleep indoors and still eat. And you have no choice at that point. When you turn it into a RIF, you have to take money out in a down market. So, my clients with real estate, we saw this out your way. I had a client in Calgary a number of years ago when Calgary was suffering, and they were retiring, and they were going to sell their properties at a fraction of what they ended up getting for them a few years later. And I said, well, why don't you just hang on to your properties, leverage your insurance contract for the next 2-3 years for your income. Then they sold their properties 3 years later, got about 50% higher number on their properties. They repaid the loan. They still had cash. Maybe they'll borrow again later in retirement, but it just frees up so many different options in retirement when all your eggs aren't in the stock market basket.
I love that. That's definitely a big point to highlight, is not being susceptible to the market changes, Now, a question for you is, when does it make sense to potentially open up a new policy versus constantly contributing to the one that you have?
Yeah. So the way we design a contract, typically, now if we know you're gonna come into some money in year two, three, four, we can build that in. But the way we design a contract, let's use that $25,000 a year savings again. And you said, okay, I want to put $25,000 in, and I'm 40 years old. Well, what we do is we drive the death benefit down to as small as legally possible in Canada. Okay, maybe it's a couple $100,000 death benefit to fit in that 25,000. But if in year one you said you wanted to put in 50,000, well, great, we'd have to put double the death benefit to put double the premium in. It would still grow at that 5 or 6%, still makes sense. But what often happens is people say, all right, I learned about this. I went through the education. Think you're full of crap. So let me do it. And they do it. And all of a sudden, year two or three comes and they're like, wow, this really is working exactly as I hoped. This is really cool. I can really do it. Let's put another 20 grand in this policy. And we're going to say, listen, there's not enough room in that policy to fit in that money. So let's start an additional policy. So I have 9 policies now. I have corporate owned policies, personal policies. I own policies on my children. You can buy policies on your kids, huge tax advantages to Canada. If you're looking to help your kids get started, you can start a policy on a 14-day-old and above. And then the business owners too, the kids and the business owners are two really unique things that we can talk about if you want, because those are really, really unique.
100%. Yeah, I'd love to, because for listeners out there who want to protect their family, or maybe they're just getting started, or maybe they're business owners. It's not rare that you have real estate investors that are entrepreneurs and business owners themselves. So yeah, let's dive into that if you don't mind.
Yeah, so in Canada, depending upon the province you are, the first $500,000 you earn in a small business, an active small business, not just a real estate holding company, but an active small business, you're going to pay 11-12% tax on that, which is awesome. Like, great, that's fantastic. So let's say 12%. So you earn $100 at the end of the year that you don't need to pay to yourself as a salary or expenses. You get $100. Okay, you're going to pay roughly, call it 12% tax. So you have $88 left. So you have $88 of retained earnings. Or you could have taken that $100 and paid it out to yourself and netted maybe 50 cents personally. So business owners across Canada go, well, 88 cents per dollar is way better than 50 cents. Why don't I leave that money inside my business? Which is great. The issue, again, going back to that number one wealth destroyer in Canada, is the tax. So when you leave that money inside your corporation, you're going to pay tax on the growth. You're going to pay tax when you get it out. You're going to pay tax when you die. You're now going to have 67% inclusion for capital gains from day one. And if you make more than $50,000 of passive income inside your corp, they're going to just decimate you on your small business first $500,000 tax deduction. So what we do is we can say, well, why don't we take those 88-cent dollars and do the insurance policy right inside the corporation? So now the corporation buys the insurance policy with you as the insured. We eliminate all 5 levels of taxation. Grows tax-free, loans are tax-free, the death benefit is tax-free, doesn't affect your passive income, no capital gains inclusion because there's no tax slip. So now we're growing those 88-cent dollars tax efficiently. That's how then you can roll that into a holding company, leverage that for your real estate, and then you can even, a little more advanced for today, but you could actually leverage those you could leverage those corporate owned policies for a personal tax-free retirement. A couple more boxes to check off on that one, but you can really, the numbers for a business owner are like mind-boggling. Like we have to warn people before we show them, like, listen, because we don't show it up front. We educate them first, and then we go, all right, I'm going to show you the numbers. I just want to let you know that you're going to be amazed, and it's not because we're earning 1,000% return. It's that we're eliminating 3, 4, or 5 levels of taxation. And that's the power of the corporate owned policies. And again, you got to make sure you structure it right, what company owns it, beneficiary and all that. But the big picture is, if you're a business owner, you should learn about this concept.
That's impressive. Now, I don't know if you know Richard Canfield. I had him on my podcast a little while back, and he discussed.
Great guy, yeah, I know Richard.
Yeah, he discussed a couple of like creative ways to use it, like for example, taking it out on a joint venture partner, taking out a policy on a joint venture partner. But I never heard this one. That's fantastic. Now let's dive into kids. What does that look like?
Yeah. So the cool thing about an insurance contract, the way we do it is you don't have to be the life insured. So there's going to be the owner, the payer, the beneficiary, and the life insured. Well, let's say, first of all, you're not insurable. You're like, oh, I can't qualify for life insurance. I couldn't pass the medical questions. Well, you could
Mm-hmm.
actually put it on a spouse or a family member, again, typically spouse or business partner, and say, great, I own it, I pay it, I'm the beneficiary, I can take the loans, I can cancel and take the cash. Or you could put it on one of your children. So typically we say, start with mom and dad, insure them
Yeah.
first. And then once you get that looked after, so I bought policies on both my kids. So I own it, I pay it, I'm the beneficiary. So I'm funding it. The money's growing tax free in there. If you think of that compound interest curve, I'm just giving my kids like a 20-year head start on that compound interest curve. So at some point down the road, it's going to accumulate a fair amount of cash. And let's say they're mid 20s or 30 or whatever, or university, whatever they want to use it for. I'm going to gift that policy to my kids if they're still great kids like they are today. So assuming they're going in the direction they are today, I'm going to say,
Yeah.
great, dad's going to gift this policy to you. But the whole time I had it, I could have borrowed 10 times against it and used it for real estate or business because I own it. They have no control over it as the life insured because I'm the owner. But now let's say 25 or 30, my goal is to gift that policy to my children. All that tax-free growth we had transfers to them completely tax-free. Now they have a vehicle where they can save money on an ongoing basis to continue to fund that if they choose, and my kids will continue to fund that. And then they can use that for their first income property, their first business, their first great opportunity, whatever that opportunity is. They can use loans, pay the loans back. But again, they got that huge jump start on the policy. And you think a business owner is sexy, they are. If you show a kid's policy, starting a kid, 5, 10, 15 years old, you don't have to put a ton of money in a kid's policy by the time they're their 60s, where there's millions of dollars in there just because you had the power of tax-free, uninterrupted compound growth for literally 50, 60 years.
I love that. What would you say that minimum could be where you could still make it work? Because of course they're a lot younger. It would be less than what you would need. As I think you said, the minimum is maybe around 10,000 a year to sort of look into this. What would it be for kids?
So for adults, 10,000. Kids, we do $400 or $500 a month policies. Probably even 300 would work. And the cool part about a kids policy, if you think of intergenerational planning. So I have 2 kids. They're not married. They don't have kids. Hopefully not anytime soon. They'll have kids. And I'm actually looking after my generation, my wife and I. We can use this policy. We can fund it.
Yeah.
If tragedy hit and there's a death benefit, we'd receive it. Hopefully that doesn't happen. Then I'm going to benefit my kids because I'm going to gift them this policy. It's going to grow tax-free. But remember, there is a death benefit in place. So my future grandkids that I haven't met yet, that haven't been born yet, they're going to benefit from the death benefit. So 3 generations have benefit from this tax-free structure. And if you start doing, we do some multiple generation planning for some clients. You start saying now the grandkids buy policies with some of the death benefit, and then their kids, like you only got to go through a couple generations when now your family's biggest concern is what philanthropy causes do you want to support? Because when you can start compounding money tax-free for that long a period and have these lump sums that come in, because everyone's going to die eventually, the numbers get mind-boggling. But to me, it's just, you can save money in an RESP for a kid. And what if your child decides not to go to university?
Yeah.
Elon Musk dropped out of university. It worked out okay for him, right? Lots of people will end up going to trade school where they don't need all the money in an RESP. Well, great. If one of my kids goes into trade school, great. Maybe I can use the policy to fund them starting a business, fund their tools. I got a buddy the other day who was telling me his son's a heavy equipment mechanic up north of you, and it's $150,000 for tools. Well, that's more than most people spend in university. So, the cool thing about the infinite banking concept is the possibilities are infinite. You're not pigeonholing your kids in, no, you have to go to university because I saved in a university savings program. And again, government backed. Is I met a
Yeah.
wealthy guy years ago and he laughed at me back when I was a traditional financial planner. And I said, oh, you should do an RSP and you'd save on tax. And he just started laughing at me and he goes, you want me to put my money in a government sponsored program? And I was like, yeah. And then anyway, so I'm walking out to the parking lot of my 20-year-old beat up car at the time and going, man, this rich guy doesn't know anything about money. And now I look back and go, well, what did he do? He invested in himself, in business, and real estate. He knew so much more than me. But I was
Yeah.
brainwashed as a young financial planner in the business because I was only educated by the insurance companies, the banks, and the mutual fund companies on this is what you should do. What they want you to do is give control of your money to them so they can
Mhm.
multiply the money. And now I teach people how to give control to the client so the client can multiply their money.
Given that story, what do you find now that you've educated, you've been doing this for many years, you've set yourself up pretty well, you've helped a lot of other people do the same. In your experience, what do you find the biggest misconception about infinite banking is?
Yeah. Why would I put my money into an insurance contract? We hear a lot, but probably the one I hear the most is it sounds too good to be true. Why isn't everybody doing it? And again, I go back to over $1 billion a year goes into it. The people what are yes, this fits really well for wealthy people, individuals, or business owners, or real estate investors. But one of the things I like about real estate investors and business owners is they've already got out of the traditional financial planning. They already saw that.
Yeah.
And most people are brainwashed into the traditional financial planning as the only path. And I always find it
Yeah.
funny that if you think 90% of the wealth in Canada is in the hands of 10% of the people. Okay. So 90% of the wealth in the hands of 10%. But what financial strategies do we follow? We follow the strategies of the 90% that only have 10% of the wealth, right?
Yeah.
So the average person doing RSPs, well, they're the 10% of wealth, but yet those are the strategies we find. So really that misconception of, oh, I shouldn't put money in insurance. When I deal with a wealthy person, they're already out of the matrix and they're like, I don't give a crap what
Mhm.
you call it. If it grows tax free, allows me to multiply my money, can leverage it tax free, guaranteed loans, take advantage of opportunities, deal with emergencies, comes with a death benefit, allows me to have tax free retirement. You can call it whatever the heck you want, Darren. I'm in. And then I'll deal with like a T4 employee who's not into real estate or business. And he's like, well, I heard insurance is a terrible spot to put your money in. I'm like, okay, great.
Yeah.
I don't need to spend 2 hours with you if you're not going to learn a little bit on your own first. That this is really what business owner and real estate investors are doing. And the accountant, actually, what's really transformed in my career is the accountants, and not all accountants. I find the big firms, because the big firms, it's funny. I was in one of the major accounting firms here, and I was meeting one of the senior guys, and it was a couple days after the last budget when they changed the capital gains inclusion. And I walk in the boardroom and he looks at me and he goes, your life must be good. And I go, well, what do you mean? He goes, you're all we have left. He goes, and they've taken away every tax strategy out there just about other than this cash value life insurance. He goes like, we used to be able to do this strip. We used to be able to, pay the kids, pay the kids at income. We used to be able to do this. We used to be able to do that. And insurance is really the number one strategy for a lot of these big accounting firms now. Whereas 20 years ago, a lot of accountants would go, oh, insurance, I don't know about that. And now I find it's the
Mm.
opposite. We work with accountants day in and day out, and they get it. They understand it.
Yeah.
So it's become more mainstream in the last 20 years. But the reality is it's been around for 150 years. It's just we people used to use this cash value life insurance for years. And then in the 60s and 70s, the stock market, or the 80s, really, the stock market got sexy. People thought they were going to make all their money in the stock market, and Wall Street sold us on that. And that's not where most people make their money. You can make money and put it in. Like, I'm not saying you can't invest in the stock market. I'm just saying, we do an exercise when we hire a new wealth coach. We go, I want you to think of every wealthy person you know, and I want you to think of how they became wealthy. And
Yeah.
I can almost guarantee you it's following investing in yourself, investing in a business, or investing in real estate. That's how true wealth is created.
100%. Wow. This has been fantastic, and I know we strive for time here, but I don't want to skip this section. I'm curious to just see how it goes. So it's honestly just a rapid fire round. So
All right.
just answer with the first thing that comes to mind, and let's just have fun with it. Okay. So
You get it.
what's the first financial habit every investor should master?
Pay yourself first.
Love that. What's the first thing you analyze when looking at a potential deal?
When am I going to get my money back?
Love it. Okay. What's the most impactful book or resource that changed the way you think about money?
Rich Dad, Poor Dad.
Okay. I thought you were going to go with
Nelson Nash, Becoming Your Own Banker.
Nelson Nash, yeah.
I was going to say the E-Myth. E-Myth, from a business owner perspective, the E-Myth is still a classic book for me.
100%. I don't even know how many times I've read that. That's definitely at least top 5 on my list there. What's the quickest way for an investor to lose control of their money?
Put it in the stock market.
So true. Darren, I honestly, I want to thank you so much for sharing your strategies and your expertise with us today. Now, as Darren mentioned, he put together a special link just for the listeners today. I'm going to leave it in the show notes below. Go ahead, follow that. There's a ton of good insight there. And he also mentioned he has a podcast episode with, what is that, 160, 170 episodes?
170 episodes, control and compound. Yep. Five.
Perfect.
We do 5 a month. And we talk about real estate investing, infinite banking, Bitcoin, and business.
Oh man, I love it. Bitcoin's in there as well. Okay. Okay, so you have no excuse for not educating yourself and leveling up. So Darren, I really want to thank you for coming on and sharing. This has been a fantastic episode. For everyone listening, thank you for tuning in. If you enjoyed today's episode, go ahead, click that link, follow through, leave a like, leave a review, and keep investing smartly. Thank you for tuning in to the Wealth Through Real Estate Show. If you're looking to maximize cash flow in your rental properties, then you don't want to miss my episode with Stephanie Misek. This is your host, Alray Noble, signing off.